Good morning and welcome to Ask the Expert, an award-winning daily series from 8:30 a.m. to 9 a.m. to help small businesses. If you have any questions, ask them in the comments of the live feed. If you need any more advice, join the official Intuit QuickBooks SMB community group on Facebook. Accountants and business experts are on hand 24/7. During this live session, we'll be running a poll, so please do engage with it, and I will reveal the results of that at the end. And make sure you register for QuickBooks free annual conference, QuickBooks Connect. Look out for that link as well. It's coming up in this feed today. And finally, the QuickBooks Connect takes place virtually on the 9th and 10th of March. The event brings a whole host of entrepreneurs, small business owners, and accountants together to really grow, learn, and connect with each other. So I look forward to seeing you there. So for those of you who don't know me already, my name is Ketan Makwana. I am the chairman of Enterprise Lab and now the newly formed 77 Ventures as well. And today we're going to be talking about my 7 principles of investing. Now, before we get into this, I do want to say a disclaimer right now that what I'm about to share with you is not advice. It doesn't constitute anything that Intuit QuickBooks represents. It's purely my tips and guidance on principles of investing. So just make sure that you're kind of taking this on board as a part of your education as opposed to formal advice that's coming through. So whether you're investing into stocks or ETFs, crypto or NFTs, becoming an investor is becoming more and more of a trend. Since the pandemic came across, 2 years ago, or started almost 2 years ago, a lot of people have had more time to spend at home, and they're also looking at multiple different ways of actually earning income or producing wealth. Well, investing is not a new thing, and it's something that if you are new to it, it can be a real minefield of what to do, where to go, and how to set about things. There's also certain things around the mindset of an investor, which is very, very important as well. So I thought I wanted to share these kind of 7 principles that I use when I look at investments. Now, why am I qualified to talk about this? Well, I've been in the investment space since 2015. I've been capital raising for my clients. I've also invested into a number of businesses within my own portfolio. I've exited companies. So I know a little bit about that side of things when it comes to investments into businesses. But I also am an active stock investor. I have my own crypto portfolio, and I do a number of things in the digital space these days as well. So I kind of wanted to share that no matter where you're investing or what you're investing into, these principles are really, really kind of transparent all the way across the board. So as I say, this is purely guidance and tips that I'm sharing with you today. It does not constitute any form of advice, and it doesn't represent any of the views for Intuit QuickBooks. So let's get started. One of the first things that I like to talk about, or principle I have, is invest what you can when you can. And what I mean by that is you don't need to sit there and try and scrounge up as much money as possible when so you can make these kind of investments. People often get absorbed by this whole thing of the more you invest, the more you can make. But investing is all about affordability. You should only invest what you can afford to invest. And it's not about actually having to create thousands and thousands of pounds. You may even start your investments for as little as £10. It doesn't need to have so much kind of money put into place there. So, one of the first things that's really important when you're building up the kind of mindset and the expectation to this is investing what you can when you can is a far better way of getting into the world of investing in wealth management or wealth creation than actually trying to force yourself to get into that actual game. One of the other things that I come across is a lot of people who ask me, they go, Ketan, how do I get into this game? When should I start? What should I invest into? What's your, what's hot, what's not? And the problem with that is that if I say anything or respond back to that, it's constituted as advice. And it's very difficult because the way I invest and what I invest into is built along my own strategies and the things that I've said and done myself. And a lot of the time, I find that when people ask me that question, they're still, even if we give them some form of guidance or tips, they're not going to really make that step forward. So the second principle I want to share with you is start as early as you can. If you are engaged into the world of wealth creation and investments, get started. Don't talk about it. Don't mull over it. Don't procrastinate. Get started. You know, most people, again, when they look at this type of income generation or wealth creation, they're very much into the whole thing of how much they can gain and how much they can lose. It's a very extreme view. It's kind of, they see other people gaining in the stock markets or in the crypto markets or whatever it is, and their wealth is increasing, but they don't have an inclination to what needs to be put in to actually be able to do that. And equally at the same time, they have this biggest fear on the dread of loss. And that's why, guys, I say to you, you know, invest what you can when you can and start as early as you can, because the quicker you get into it, the sooner you're going to start to actually be able to build a bit of a routine. And that word routine brings the next principle in: invest consistently. Let me say that again: invest consistently. And what I mean by that is, if you had £300 of your savings that you were preparing to invest, don't invest all 300 in one go. Okay, maybe split it up into groups of batches of £10, £20, £30, and actually create a weekly investment schedule where every week you're investing £10 to £30. Now that consistency produces a routine, which routine turns into habit, and then habit turns into that natural instinctive behavior. What it also does is it gives you this kind of opportunity to actually be able to, and I'll say that at this moment, flirt with the markets in a way which you can then start to understand what's working for you and what's not. See, if you went and invested all 300 in one go, that's a punt. That's not investment. That's punting. That's almost like gambling. You're putting a punt, you're hoping it's going to come through, your horses are going to come in exactly, and then poof, away you go. You know, you think you're going to have radical winnings or you're going to have radical losses. This way, by investing consistently, you safeguard or protect the money that you have, but at the same time, you produce this behavior and routine, which will start to become second nature to you. Now, when you are in investments, the last thing you really want to do is put all your eggs in one basket. Again, so the word that will come up, or you may hear it from time to time, is hedging or hedge your. And now it's not hedging your bets, because remember, investments, as much as capital's at risk and the capital you invest is always at risk, it's not gambling. Okay, it's actually calculated investments for return. You've got to study the markets. You've got to study what you're investing into. You've got to understand, you know, if it's on an incline or a decline. At the end of the day, you can invest in stocks or things going up and stocks coming down in terms of value. Now, those are the kind of different things that come in terms of investment strategies. But diversifying, which is the next principle I want to share with you, is very, very important. Create different levels of investments because, one, it broadens your horizon of your investment portfolio. Two, what it does is it produces a much, much more safer kind of hedging, where if one stock or one asset was to do really well and another isn't, it can compensate for the losses on the other one that's not doing so well itself. And three, you will actually start to learn more and more about other active markets where investment could be really, really strong. So, you know, think about it's not just the biggest sort of FTSE 100 companies that you want to buy investment stocks into. There are a lot of other companies like, you know, emerging technologies, which are kind of coming in, climate or green tech companies, which you may want to invest into. Now, you know, there are things like stocks, there are ETFs, which are sort of lighter versions of bundles of those actual stocks itself, which you can do on platforms like eToro and stuff like that. You know, not that I'm actually endorsing those at any way, shape, or form. And then you've also got things like crypto, but crypto is a very volatile market, so it's gonna go up and down increasingly. So for that reason, when you're looking at investments, what you want to do is think long term. So my next principle is about your strategy. If you're coming in to make a quick buck, a quick turnaround, this is not the right game for you. Investments is all about long-term strategy. You've got to ignore short-term fluctuations. And what I mean by that is you will see sometimes that as you invest in, because the market is in such a situational place, the stock's price soars, which means that you get kind of excited and you think, oh my God, maybe I should be pulling out my money. At the same time, as it goes up, it will sharply come back down again. And that's just the market re-correcting itself or re-regulating itself. And that kind of keeps you down to the thing of, oh my God, I should have dropped out at that higher price. I've lost money. You haven't lost money because you haven't cashed in as yet. And the thing is, you'll always get short-term fluctuation in investments, and that's natural. That's because of market conditions. You've got whale investors coming in and buying a lot of stock. So obviously, simple economics suggests that if there is a high demand and low supply, the price goes up, and vice versa. When the supply is very high, so there's a lot of stock available and a lot of people cashing out, the price of that stock starts to come down. Now, it could be in your favor to actually be buying more of that kind of stock as it comes down in price, which means that you're getting it at a lower price. And as the stock starts to increase, you could then create a whole strategy around swing trading. And what I mean by swing trading is where you take the profit out of the asset that you've invested into and then directly invest it into another asset itself. So it's important that you go along this kind of line. Now, as I said to you earlier, as a point of a disclaimer, this is purely tips and sharing guidance and stuff. It doesn't constitute advice. One of my next principles is invest in what you believe in. You'll hear a lot about people saying, oh, I made money on this and I made money on that and all of this kind of stuff. That's great. But again, all you're seeing is 2 or 3% of the iceberg, the tip of the iceberg, which is normally above the surface of the water. Everything else that's gone on underneath, you're not really looking at. So if you get duped into it, or if you get influenced into buying into something because someone else believes in it, that's not going to work for you, because it's not something that you have a quantifiable belief, or you agree or can see that there is an opportunity here. Investment's all about your own belief. Why would you invest into something? Because you can see the potential in it, not anything else. Because you see it, not because anyone else sees it. So copying investments it is possible, and it is done in terms of mirroring what investment strategies are out there. But be mindful of the fact that what you're doing is you're following someone else's belief system. When things go right and things go wrong, they have a particular way of responding to it. You'll have a very different way of responding to it. One of the last things that I want to talk about is, again, comes back to the very first principle about invest what you can when you can. And that final investment principle is never borrow money to invest. Okay. We are not sophisticated investors. We don't work in Wall Street or in the city in this kind of particular way. Those kind of entities and makeups are all built around systems and structures and strategies and risk and mitigation that they've all piled into everything that they will do within their investment, which gives them the opportunity to then consider borrowing money to invest to actually make the profit. Banks do those kind of things where, as you put into your pension funds or potential other kind of financial products, there could be a stakeholder element of this where the banks will actually go ahead and invest into stocks to actually help increase the value of your pot. Now, you're not that sophisticated. I'm not that sophisticated, so I would never borrow money to invest. And I'm not saying that you don't do it. I'm actually instilling myself to the fact that the more you go into a habit of borrowing to invest, the more you're going into this kind of area of gambling, because you've got to first be able to afford to repay what you borrow. And the second thing is, if you lose what you've borrowed in the stock markets, you're now going to be at a loss both in your stock and your inability to repay that debt that you have for borrowing. So there are my 7 principles. As I said, these are purely tips, things to kind of introduce you into, for those of you that are at an entry level or an intermediary level when it comes to investing. I hope you found those tips useful, but I am really keen to get onto some of these kind of questions that you have. So let's get started with this. So I got Morgan from Facebook Messenger, whose question is, do you have any tips on prioritizing time and workload? I've been bogged down with work that I've not had any time to dedicate my own personal development over the last 12 months. Okay, so this question is primarily around investment of time, as pardon the pun, basically. But what we're talking about here is priority and time management. This really comes down to one simple thing, Morgan. And in my opinion, it's decision-making, effective decision-making. Your effective decision-making will determine how much time you spend in something, how much time you don't spend in something. And I think that the words like you've used here, bogged down with work, kind of intimates to me that what you're doing is you're kind of entrapped into this kind of hamster wheel of, doing things that you perhaps don't enjoy, that you're not intensely engaged into, or you are not really ultimately qualified to be doing. So for that reason, what you're doing is you're searching for lots of different ways to try and accomplish the task or the activity. So one strategy I have for you is come back into yourself, ask yourself the most important questions, which is really about your emotional energy. A lot of productivity and performance comes from the way we feel. There are 7 levels of energy in our bodies, but we don't go through these sequentially, and we don't go through energy management or energy leadership in equal amounts of time. 3 of these are catabolic, 4 of them are anabolic. And what I mean by that is 3 of these are destructive and 4 of them are constructive. They build you up. But if we took the extremes of level 1 and level 7, level 1 is fear, frustration, anger, resistance, reluctancy. Whereas level 7 is euphoria, all of that kind of optimism, etc. Both of these energies have a direct influence in the way that we show up, the way we approach the work we do, and the results that we can achieve. When you're in a catabolic state, it's going to undo all the stuff. You're gonna see a touch point of that coming into your work. And if you are in that kind of level 7 state, you're going to overexert yourself. You're going to become very, very over enthusiastic. You overexert, and that creates mental burnout. So this is all about consciousness, bringing back a little bit of becoming conscious. Ask yourself those kind of questions. Not, do I want to do this work? You have to do the work. It's what level of energy do you feel you're at? And based on that, give it a response. So it's more about your decision making rather than your time management. Krisha on Instagram DM, I've always struggled a bit with why we should start investing. I'm a bit too busy trying to grow my business and create value there. What benefits could I be missing out on? It's a great question, Krisha. And actually, look, the way in which you've asked that question would open and lead you to be convinced that investing is it's something that you should be doing. Investment is not right for everyone. It's not necessary for everyone. That's why I said one of my first principles, invest what you can when you can. And one of the other principles was invest in what you believe in. If you are busy building your business, that's great. Invest your time into that. A little bit like what I was saying with Morgan. Now, if you feel that, the parade is passing you by, there's obviously something within yourself that's attracting you towards this. But the reason why you haven't done this is not because you're busy building your business. You're still not convinced or sure it's right for you. And for me, if there is 1% of doubt, that's like a hairline crack on a wall. If you leave it there, it will become bigger and bigger and bigger, and eventually the wall will crumble because of that hairline crack. And it's the same thing for you. You will end up making a snap decision, which isn't calculated. It's more of a risk. It's very high risk, and it's got a very high gamble. So take your time. Do what's important for you right now. Build your business, and if time allows and your inclination allows you, learn more about the market and then build a system that works for you. Investment isn't something that you've got to do in this particular way or format. It's, you know, it's something that you do when you can, how you can. But if you are going into this, if you are going to say to yourself, yeah, I want to get into investment and wealth management and wealth creation, then do it. Don't talk about it, just do it. Because the more you sit on procrastination, the less you're going to do about it, the more you'll see opportunities pass you by, the more you'll start resenting things. Again, that will lead you to snap decisions. Really good stuff here. Isaac on Twitter DM. There are hundreds, if not thousands, of companies we can invest in. How can we sort through it all? It's a great question, Isaac. Now, one of the most important things to remember in anything, and the rules of thumb when it comes to investment, are two things. Your capital is always at risk, and do your own research. Okay, now there are, you see, you can go onto platforms today and you'll see that more and more of these types of platforms provide you with more insights and intel about the performance of that company over the last 30 days, over the last month, etc., how it's trading throughout the days, the minutes, etc. But what you've got to learn about more is about the information surrounding that stock. So if it's a company that you're investing into or a product that you're investing into, you need to go and research it, understand. For example, Apple last week announced that it's starting to flirt with the metaverse market, and you know, they're bringing in a lot more virtual reality thing. In fact, they've got their own virtual reality headsets coming out very, very soon. These are going to compete against Oculus, and as that announcement was made, their stock rised by 8%. Automatically shot up by 8%. So people in the market who already knew this was coming 2-3 weeks ago may have started to invest into the Apple stock, knowing that it's going to rise up, waiting for that rise, and then actually being able to swing trade the profit that they make off the stock. So my kind of guidance to you here is do your research. Don't just listen to something and then just go off and do it. Do the research, build up to it, because all of this kind of information is available to you well in advance. Don't be a retail investor. And what a retail investor is someone who reads something in the news or in a newspaper and then goes off and buys it. Because by the time you go on to buy the Apple stock, it's already soared plus 8%. You're buying it at a price which isn't its true reflection. Because after the stock goes up by 8%, over a period of time, it will plateau down. So what you will be is you were bought at a high level and actually saw your stock depreciate in value, which will put a bitter taste in your mouth. Great question though there. Sarah on Instagram DM. I think a lot of people misjudge the level of risk when it comes to investing. Do you have any tips on how to assess the risk level? Sarah, it's a brilliant question. Again, it comes down to your research. You know, you've got there is obviously going to be a level of risk that you've got to put in, but it's a calculated risk. You've got to understand just how I explained that thing for Isaac in the fact that Apple stock shot up. When you look at investment and the risk of investment, the risks are usually in high volatile stocks. So those kind of things like Tesla that go up and down, because of, or if you're looking at crypto, the volatility of those markets and the uncertainties creates that kind of roller coaster effect. So sometimes maybe when you're getting into the market, it's better for you to work with more risk averse type of portfolios. So things that have a steady, stable path. It's a bit boring, but remember, investments are a lot more long-term rather than the short-term base. So perhaps building upon that. But again, the biggest tip that I would have about assessing risk levels is actually do your research. So if you are looking to get into tech investments, be making sure that you're subscribed to different tech magazines, picking up things from perhaps things like Sifted EU or TechCrunch, because this is the kind of information that comes out well in advance of something going to be happening. It will allow you to start understanding how it's going to have an impact on the market and for how long, because your strategy could be very similar to those that invested into the Apple stocks just before it went up by 8%, that they're not in this for the long run. They're in to actually claim the profit and then be able to swing trade that so they can buy other assets. That's helping them diversify their portfolio. Diversification is also a very, very important thing when managing your risks. So, Carrie from Facebook Messenger. I never really looked into investing out of a worry I'd lose all my money, or the money, or not really knowing what I'm doing. I know I have a bit of spare income, and I think it may be an idea. How do I dip my toe to gain some initial experience? Where do I start? Okay, there are a couple of different questions in that. It's a brilliant thing, and I guess this is on the mind of a lot of people who are perhaps new to investing. Number one, you can't dip your toe. Get that out of your head straight away. As I said earlier, in principle, if you're going to get in, you've got to start early. Now, whatever you're working with, it's got to be income or savings that you can afford to lose. So a bit like when they talk about going into a casino, you should only bet or work with the money that you can afford to lose. It's the same thing here. So if you've got, I don't know, £10,000 of savings, don't put all £10,000 in. Start with £1,000. You know, to alleviate a little bit of risk. What you're doing is you're not dipping your toe to experience what stocks and investing is about. You're actually investing £1,000 in to build the experience and expertise of building wealth off that £1,000. So you need to really reshift that mindset, because if you go in at it dipping your toe, you're always going to have this whole thing of I want profits. I don't want to lose. Obviously, everyone wants to win. No one wants to lose. But sometimes you have to lose to gain, if this makes sense. So your whole experience needs to be built around how you are going to, what relationship investment or investing is going to have in your life as you go through. So my guidance to you here is don't use all of your income and savings. Take a small proportion of that. Go in to start with these types of ETF and stock trading platforms like eToro and others that are available, and slowly build up your confidence and your competence in there, which will then allow you to either do more significant investments, more broader, wider investments, or more higher risk investments. Remember, high risk investments bring a higher reward as well. Okay, Karim on Twitter, DM. There is a world of information on the internet about investing that sometimes it's hard to know what is and isn't valuable. How should we be navigating this information? Well, it's important that information that you consume off the internet is also validated through other kind of networks and communities. Sometimes it's worth coming back into platforms like QuickBooks, SMB, Facebook group, talking to accountants, talking to other entrepreneurs in those kind of networks, saying, I read about this and this is my viewpoint on it. Can anyone share some light onto this? Information is just that. It's all information. It's how you perceive this and how you align it to be valuable to you in this particular sequence itself. So don't just believe everything that you read, don't essentially follow everything that you search on Google itself. Validate that information through conversation. Last question I'm going to take today, Louis on Facebook Messenger. NFTs confuse me a little bit. I see the point of art. The value of famous paintings may be ridiculous, but it's the original of the first. An NFT claims to be an original, but there are multiple duplications of this piece across the internet. How is an NFT more valuable? Okay, this is something that I talk a lot about. So if you want to come over and follow me on LinkedIn, I've got a lot of stuff around NFT and the metaverses over there. But very short, simple response that I'll have to this, Louis, is that NFTs are by and large original digital art content. It could be just one small pixel, which is slightly different, that creates its unique standpoint. Actually, NFTs started more as the digital version of collectibles. So creating a collection of different art and then trading those collectibles. it's actually moving more towards the space of community now. So you've got the future of communities and groups and clubs, which are going to be built upon access and entry using NFT acquisition. So simple things like the Bored Ape Yacht Club is a group of celebrities. We're mainly celebrities that buy these pieces at some extortionate prices on the market space. But a dear friend of mine, Gary Vaynerchuk, or some of you may know Gary V, he started a whole club called Bluefish, which is all high experience dining. But in order to be a member of that club, you have to acquire an NFT. So NFTs have value in different ways. It's not just the actual originality of the art. It's also about what that art, that collectible can have or give you access to in the future. So start to think of it as almost your ticket into things, as opposed to just a piece of art that you've built. And remember, like investments, NFTs will have the opportunity of going up in value and also coming down in value. So in that case, you would go to places like OpenSea.io and have a look. And when you can see what the floor price is of the NFT, that will give you the average cost of what this type of collectible art is. You know, they can start at 0.5 Ethereum. And if Ethereum is at £3,000 a token, you're talking about £1,500 value for that collectible. But within the space of weeks, it can go up to something like 10 Ethereum, and then means that the art has grown into, the floor price of it has increased subsequently, making your art much more valuable in the market. Again, your option. You want to sell it, go into the market. You want to trade it, you go into the market. You want to keep it, that's entirely up to you. All right, I really enjoyed those kind of questions, and I hope that kind of helps a little bit on the NFT side. So we did ask you a poll, if you remember, and that poll, we asked you, how comfortable do you feel when with investing? And the results are as follows. 20% of you said we're very comfortable. 30% of you just said, I'm really just getting started, and 50% answered, don't think it's for me. It's great. It's really good to know. So look, those of you that are very comfortable with investing, that's great, but don't become complacent. You have to keep your learning going. For those of you just getting started, remember, you are just getting started. To make an omelet, you have to break eggs. So expect everything, not to go as according to full plans, the way you visualize things, but learn through things. Go and talk to other people. Go and read up about what you're trying to invest into, and create that consistency of investing as a habit, rather than the punt that one would put because of the fear of missing out in the richness of stocks soaring, etc. And then for those that don't think it's for them, that's absolutely fine. I think it's brilliant that you've got to that kind of decision at this moment in time. But if it does percolate in your head from time to time, as I told Krisha earlier in this Ask the Expert, it's okay. Just build up to it, do your research, and get into it when you believe you're ready. Okay, so look, thank you for all tuning in. If you've got any more questions, feel free to tweet me on Twitter at Ketan_Makwana. Coming up on Ask the Expert on Monday is Aaron Patrick, an accountant, QuickBooks Pro advisor, and the founder of Bofix. Tune in and get advice on accounting and the latest features and tools that will make your bookkeeping even easier. Believe me, I'm going to be tuning in because I want to do that as myself as well. A reminder that if you need more advice, join the official Intuit QuickBooks SMB community group on Facebook. Accountants and business experts are on hand 24/7. I've really enjoyed answering your questions this morning. Have a great day, but don't forget to sign up for the QuickBooks Connect event, which is coming up on the 9th and 10th of March. I'll be there speaking about crypto and digital assets, and I hope I'll see you there too.